Okay, so what is a 457 deferred compensation plan? Many clients refer to this as a 457 account. They refer to it as a deferred compensation. And so just to keep it straight, the full name is a 457 deferred compensation plan. It's a government savings plan for government employees. It's funded through your payroll deduction and it is pre-tax. It grows tax deferred. So when you that just means that when you put it money in there, it's not taxed, but when you use it later on, it is taxable, and that with the growth of the money is not taxable year to year. And this is designed specifically for the public sector employees. This plan. Why do we participate? So we participate because it reduces many different reasons people participate, but it reduces your current taxable income first and foremost. You can build supplemental retirement income, which basically you can supplement that with if you have a pension or a 401k, you can utilize these monies when you separate service. And then you control how much and how often you contribute. So generally speaking, you would pick a dollar amount and that dollar amount you can change. Whether you want to go up, down, or stop, you're able to do that anytime. And then it works alongside with your pension or 401a plans, as I mentioned. Who is eligible? So all full-time employees are eligible. These rules obviously are set up by the city of Detroit. Eligibility begins day one because it does come out of payroll deduction. Enrollment into the plan is either, I advise one-on-one consultation because that's when we go over the plan, the details, the investments, et cetera, because everybody's at a different level of understanding it. So, I always advise one-on-one. If not, you're able to do it directly online through the computer, or we can do it over the phone or virtually. Contribution limits, people ask how much they can put, what's the maximum? The maximum per year for any individual, regardless of age, is $23,500. So it's the same amount that you could do if someone has a 401k somewhere else or a spouse does. And if you're over age 50, there's a catch-up provision that you can add an additional $7,500 a year. And then within a 457 specifically, unlike a 401k, there is a special catch-up that somebody, if they're in their last 3 years and they're eligible for retirement, they can technically do double the amount that the standard contribution would be. And in this case, the standard is $23,500. So if we multiply that by 2, it's $47,000, which is obviously a ton of money. People usually take advantage of this if they have sick payouts or vacation payouts at the end, and they're able to put this in, or if they have a spouse that is earning the main income and they can put additional money in, they can get additional tax savings. So, but you cannot do both catch-ups, as the last item here says, so you can't utilize the age 50 and the special catch-up at the same time. It's one or the other. So as I mentioned, these are automatic deducted pre-tax from your paycheck. You choose a contribution amount. Changes can be made throughout the year via Equitable, and we basically at this moment we're utilizing a payroll form that the city of Detroit provides, so that amount could be changed, and the investments grow tax deferred. The investment options within the portfolio, there's a wide range of funds and fixed income options, which basically means for somebody that says, hey, I just want to save my money, I don't want to have any market ups and downs, and they can be actually under the umbrella of our account and also have a fixed option. So they're getting a tax advantage, but they're not getting any volatility in the market. And we'll talk about that later. All of our funds, they include target date funds, which are just funds that are built around, a specific future retirement date, and they automatically adjust on their own. And then there's also funds which emphasize growth or conservative options, which basically I help you pick those. That's what I'm licensed to do. I help you pick those funds built around whatever your risk is. And I'll show you some of those funds in a second here. And then the tools and projections available through Equitable's site of, financial calculators, et cetera. And we will go through some of those items as well. So another question I get quite often is, how do I get my money out? And this is a very common question, and it's a great question. So unlike a 401k, it's a little bit different than a 401k, where a 401k technically you would say 59 and a half. So a 457, knowing that it's a governmental plan, it has a little different rules on the withdrawal rules. So first, there's no 10% early withdrawal penalty. And how do you actually get it out? Income taxes apply upon distribution. So when you take a withdrawal, you're going to pay tax on the money as ordinary income, as if you were receiving a paycheck, for example. The withdrawals, how are withdrawals allowed? Oops, sorry. Withdrawals are allowed based on separation of service. So whether you just retire from the city, whether you move on to a different job in the future, that money is said to be utilized. If you choose to use it, you can. You do not have a withdrawal penalty from Equitable, nor do you have a penalty from the IRS. You just pay tax on that. And the IRS refers that to as separation of service. So in any way, shape, or form that you leave your current employer, the city of Detroit, you have access to that money. And of course, at retirement or qualified emergencies with approval. As of right now, the approval comes directly based on unforeseeable hardship rules from the IRS. And that's what the city and Equitable follows when it comes to while you're working withdrawing. It's called a hardship withdrawal. All right, accessing your Equitable account. So of course, many tools nowadays allow you to utilize an app. Equitable does the same. So you can pull up your account and look at it on a daily basis, 24/7, by visiting equitable.com. Use your personal info to register, just like you would anything else that you're registering into. And then you can view your account balance, your contribution history, like how much have you put away and when did you start the contributions or the plan. And you can look at your fund performance, of course. I would definitely wouldn't recommend that daily, especially with the different markets that change every day. But you definitely have access to do that. And you can pull up old statements, et cetera, in there. You can also access financial planning tools, as I mentioned before, and calculators that may help with some planning in the future. So enrolling, basically, as I mentioned, you can do that one-on-one with your advisor, which I highly recommend a one-on-one appointment, because that's really how people better understand what they do. And we can put kind of paper to pen, but many people nowadays are also wanting to have virtual or over the phone, and we're happy to do that as well. We also do have online. And then go ahead. So common question that I get, and I think I mentioned this during the presentation, can I change my contributions anytime? Yes. I generally like to tell my clients, once we make a change to your contributions and I send it into the city, it usually takes about 2 payrolls to 3 payrolls for it to go into effect. So from a planning perspective, if you're worrying about it going up or you're lowering the amount or stopping it, consider doing it a little earlier than expected, so that it goes into effect sooner than later. But generally, it takes 2 to 3 paychecks. Hopefully, that time frame will shorten in the future with technology, of course. Can I transfer funds from another plan? This is another common question. Yes, you can. It is possible. You have to just check with us as your agent to see if it's a plan that is allowable to come under the umbrella of the City Detroit 457 plan. And then what if I leave my job? You can keep your plan the way it is, because the rules are very important for a 457, is that you can use the money when you separate service. We find many people that retire or leave the employer younger, say in their under 50s, and they're able to utilize that money without an IRS penalty while it's under the 457 plan still. And so that's the basics. Here's my contact information for anybody that liked it. And we'll definitely share that, I'm sure, in the chat. And there's a couple minor things I do want to go over just to, show you a little bit more in reference to how the markets have been acting lately and how it affects you, and in different tools to kind of, really understand it a little better. So the first item here, I get clients that ask me, these are just our investment choices. So you can see anything from American funds, if you've heard of American funds, BlackRock, Fidelity, T. Rowe Price, JP Morgan, Vanguard, etc. So these are just our investment options within our portfolio, which we definitely will go over and that you have access to within the Equitable plan. One more item I do want to go over with you, a couple items here is the dollar cost averaging. So what I mean by dollar cost averaging is that because recently you've seen a lot of market volatility, meaning a lot of fluctuation up and down in the market, it's important because people ask us, should I stop investing when the market's down? And technically, that's probably the worst time to stop investing, because what happens is when the market's down, you're buying things at a cheaper price. And the key to that is understanding, when you're buying things at a cheaper price, you're buying more of them. So your dollar is able to go a lot farther. So if you look at the first column where it says investment amount, I just have on there $100. So every paycheck, if you were doing $100 or $50 a pay and $100 a month total. And if you look at the third column, just like if you had, for example, if you looked at Ford stock, you say price per share. When I first bought them in January, it was $10. In February is 11. And you kind of follow that down and you see it going up and down and same as original price. And then if you look at that fourth column there, it's starting to show you you're buying more or less of the shares. But I think the key to this I want to kind of show you is that when the markets are up and down, if you look here where it says the hypothetical example, you can see you bought some shares at $15. You bought some shares at a lower price at $10 by doing this every 2 weeks. And then you look at your average price is $12.83. So when it comes to investing, you want to always be invested consistently, regardless of the fluctuations of market, and pretty much stick to your plan. Because at the end of the day, when the market goes down, you're just buying things cheaper and on sale. That's one thing I want to just briefly go over. Another item that I'm just going to briefly kind of go through. So this hypothetical, let's just say you have a goal of 300,000. In this case, I know it shows 500,000, but the main emphasis of this slide is to look at the cost of waiting. So I get many clients that say, okay, you know what, I can't afford to do it right now. Or they say, I'm going to start it in 5 years, and everybody has their own expenses at home. And I totally understand that. But I think it's important to get an idea on a scale to understand what's the cost of waiting 5 years or 10 years, because there's many people I run into that say, oh, I wish I did this 5 years ago. I wish I did this 3 years ago when I saw you, whatever. And I just wanted to put it into numbers. And so let's just say someone started to save at 25 and they retired 40 years later. So they were investing for 40 years, whether retired or just purely not touching the money. So for you to get to a goal of $500,000, when you're 25, if you do $189 a month, which comes out to $90 a paycheck, and that fourth column there, it'll show you that you contributed of your own money $90,905, right? So the key to this is time. And it's important when we go over, when a client tells me, well, is this a good time to invest or not? I always tell them the first dollar is going to make you the most money, because the longer that dollar is sitting there at a younger age or a younger time period, it's going to compound with compounding interest the most. So that's why your first dollar makes the most. And if somebody just said, hey, I'm going to wait 5 years, so at age 30 here that you see on the left-hand side, and they invested for 35 years, well, now they have to put away $276 per month in order to catch up to that person that did it 5 years ago. And you can kind of see the numbers down here. If they waited till age 40, they have less time to invest. And then now you have to put away $614 to get to that same goal. And lastly, I wanted to cover, and we can definitely go over any of these after, but I wanted to cover a tool that we utilize with a lot of clients that really tell us, hey, I would like to know in 20 years, am I going to have enough money to retire? Or in 10 years, am I going to have enough money to retire? And so we do something called an asset map. And I look at it more as a roadmap for retirement. But why I like it is because it's simple, it's transparent, and it's short. And we can adjust this whenever we do a review. So I'll just briefly go over this. So you can see here on this page, it has a husband and wife, and we could do this for one person or two people. But it shows where you have an income for your employment income up on the left-hand side there. And everything on the left-hand side has to do with one person. So if they have a pension that they're going to expect in the future, if they have Social Security to expect in the future, we do all those calculations for you based on your current pension, based on your current income, and we figure out the Social Security piece. And then if you have a 457 deferred comp, Roth IRA, bank, etc., we calculate all those. So it's a good place to inventory everything, even if it's not with Equitable, is fine. But it's good to gather the data. And then, of course, if someone has disability insurance, life insurance, you see in the middle upper column area, and then we take into account their current home value and their mortgage. Now, of course, home value and mortgage doesn't have anything to do with your future income, but they are considered an asset, so it's a placeholder in here. But what I like the most out of this, besides having everything on one sheet, is that the second page here, it tells you if you're going to be able to achieve your goals. Now, when you look at this person, the sample here, it says that it's 81% funded. And 9 times out of 10, this person definitely will achieve their goals. Most of us look for 100% funded or better. Just if you're looking at a pension, you want it 100% funded or better. But based on this example, 81% is really good. And let me explain why. So we're very conservative how we look at this. So if you look under the area where it says what you want, this is strictly driven by what your goals are. If you tell us we need, in this example, that you want to retire at age 60 and that you want $72,000 a year in income, we add in inflation here at an average of 2%. And we do this conservatively over 40 years, which means we have you living till age 100. So that's why when I say this is conservative and I say that 81% funded is really good, is because we have your mortality out to age 100. We also put in here travel expenses. People usually have a budget for that or choose to want to have a budget in the future. So I utilize travel expenses of, in this example, $7,500 a year. I adjust it with inflation because we know today's dollar is not going to be the same dollar 20 years from now. And then we also incorporate possible medical expenses into the budget. So these are things that you could see as a little more detailed for somebody that wants a longer term plan and have some longer term goals. And they really want to have some intentional investing and being a part of the whole process. And this is helpful for many people. So I think that will end the formal part of the presentation. If there's any questions, I'm happy to answer them. If somebody wants to unmute, you're welcome to. Craig and Jocelyn, I don't know how you guys want to operate this, but I'm happy to address any questions people may have.
Okay, thank you so much, Jihad, for your presentation. That was very informative. I am going to drop a quick poll in the chat. Earlier, Craig asked if who was a current participant of Equitable, and you can just reply in the chat yes or no. And while you're doing that, we do have a couple of questions. And the first one is, can the deferred compensation plan be converted to a Roth 401k?
So it cannot, because the deferred compensation plan is a pre-tax. The Roth 401k is after tax money. So if you convert that outside, for example, of the city, that creates a taxable event. And of course, this is more of an accounting question, but at the same time, you're dealing with money that's before tax, and then the Roth is after tax money. So that is a taxable event when you convert it. And also the plan, because this plan, the 457, is under an employer sponsored plan. So it's a little more unique than somebody having an individual 401k, where the plan has the rules that they follow with the IRS. So the plan under the city of Detroit, they can accept or reject what things can and can't be done. But what supersedes all of us is obviously the IRS rules. So yeah, converting the money to a Roth 401k is a taxable event.
Okay. And Jihad, can you go over how to have a one-on-one with you
Yeah,
and
definitely.
your contact information?
Absolutely. So I have within my email that I can send to anybody on here. I can send you my email address. And when you get my email, there'll be somewhere on my email where there'll be an embedded, a highlighted area where you can just click on and you can schedule a time in person, virtually over the phone, right from there. So you don't even need to, or you can obviously pick up the phone and call me. I've had the same cell number since I've been in the business, and I still have that on my business card. And maybe I'll just put that into the chat. Is that appropriate,
Yes,
Jocelyn?
you can put it in the
Geraldine?
chat.
Okay.
hmm I have one more question. Then I have two
Take your
people
time.
with their hands raised, and I will come to them. Can you go back to the example of investment worksheet example?
Investment worksheet example. I definitely can. Is that where the actual investment choices were, or the
Leslie,
dollar
if you
cost
want to
averaging?
unmute yourself and
It was the last example where you had showed the investment amounts, how much you started off with per month, and the total value, how it accumulated over the year. The last example that you had up.
Okay, I'll bring them on and see which one it is, just to make sure I get your right one here, of course.
Okay,
yeah,
thank you.
and Leslie, you
Absolutely.
will receive a copy of the presentation as well. It will be added to our series of financial
Okay,
webinars
yeah.
on our YouTube page.
Okay.
Is this the page you're referring to?
That's the first one, but that's um is that going to be what you're going to return to? Is that one?
Yeah, this one right here is the one you like?
Yes.
Okay. What question did you have on this one
I didn't
that I
have a
can help?
question. I just want to look at it
Oh,
for later
okay,
on.
absolutely. Yeah, and we'll definitely send this out.
Okay. All right.
Yeah,
Thank you.
the main emphasis of this is the cost of waiting, right?
Yeah.
And you know, we can set a total, like if you look all the way to the right, we can set the total goal of 100,000, right? And then and go backwards from there of you know how much you need to save to get to that. And we can run through plenty of calculators to get to whatever goals that you place on it.
And the one after that. It's one more.
This
Um,
one,
no, not that one. That one.
okay. What question did you have on this one?
I just wanted to copy it so I could go back and look at it. I just wanted to take a copy of it.
Yeah, and we will definitely send this out to you. Geraldine,
Okay.
is that correct? We're gonna,
That is absolutely correct. Yes.
yeah,
Okay. All right. Thank you.
Okay.
Appreciate it.
Thank you,
anytime.
Leslie.
And I can definitely go over it individually with you because everybody has a different time when they start and all that good stuff and have different questions. So that's helpful for sure.
Yes.
Thank you. Good
Doug.
presentation.
hmm
Thank you. This is I just have to warn you. This is my first time that we've done this in the city of Detroit, and I guess I'm the first one doing it for the series of them. So I really appreciate it. But and it's untraditional for me to do this like this, but I'm happy to be a part of it, and hopefully more to come. It's a
Yes.
good way to get out the information to everybody conveniently at the same time.
It is. I have Douglas. If you want to unmute yourself, you can go ahead and ask your question.
Oh, hi. My name's Douglas Ortiz. I'm at the City of Detroit in OCFO. I had a question. I'm currently in deferred compensation with Vanguard, but I haven't
Mhm.
been super impressed with, you know, the support services that come with retirement planning that we need. And I really liked how you explained all this in your presentation today. I was just wondering if you could talk more about like how you help folks like us just like on the financial planning side, like what kind of consultations do you do, and is there a fee for that? Could you just talk more about that?
Absolutely. I appreciate it. Thanks for the question, Doug. So I'm going to bring up something in a second here, but let me just give you a verbal response to that question. So I've found over 25 years it's extremely important to have a one-on-one relationship with my clients because of what you just said. They need somebody they can reach out to. They need an individual. They don't need an 800 number. All the companies that are offered to you guys are great companies. There's no, hands down, you guys have great choices within your platform. And because you have more than one company, it gives you the ability to balance what your needs are. And from the standpoint that how we handle it and how I handle my clients is we do a one-on-one consultation. From a cost side of it, I get paid based on how you're invested. There's not a separate check you write me. I know that's a good common question. So just to make that across the board clear. And then we create expectations. So if I meet with somebody and they're just starting out investing and they just, started in a new career, generally they just want to start off, right? They just want to get enrolled and start the ball rolling. And then I come across people that they either come from another employer or they've been investing for a while. They're not really sure what they're doing. So when I sit down with that client, we go over the investments a little more specifically. We go over, how you should be invested based on what your risk is. And I dig that out of each individual client because they're all different with different situations. I think the more intentional advising is extremely important. When I say intentional advising is knowing how you're invested. What are we invested into? You should expect a consultation at a bare minimum when you're a client of ours once a year. Of course, you're going to have access, directly to my cell, so you can call me more often or email. That's non-negotiable. You can always, reach out. That's not a problem. But I make it upon myself, at least on the birthdays at a minimum. I find it is a good time to wish somebody happy birthday. And sometimes they have questions where they want to, get together or meet in the future and go over their current investments or their household investments. And I think the last piece of it, Doug, I think when I say intentional, that last item I showed you, that asset map, that really brings everything together. It really addresses, future planning, current planning, but shows future goals. So I think that asset map is a very simple way that takes me about 5 minutes of questions with you to get it filled out. And then I kick you back the outcome. And then we kind of work around that to adjust it based on what your needs are, what your goals are. So I think that's very important. Lastly, I will say I have a team. I'm not a one-man show or one-woman show. We have a team of about 4 or 5 advisors. I do have a couple of CFPs on that are partners of mine for anybody that really wants a certified financial plan. But I find in most cases, 98% of people don't need that. I think the asset map is something that's sufficient, doesn't cost you anything. It's something that we do with all of our clients that want to do it. And that are intentional about how they're investing and they're a little further down the line that they really want to see more longer term goals. So hopefully to that, and education wise, I think that's key. I go into a lot of schools in a lot of cities and I tell my teachers that I deal with, I say, listen, I'm your education. You're my student now and vice versa when they're with the student in their classroom. So I'm here as a resource. And you can ask me pretty much any question and I'll help guide you through those answers. Does that answer everything, Doug? I know it's a little long answer, but I wanted to touch on everything so that everybody gets an idea of what we can do.
No, I think that yes, that does. And I will reach out via your contact information. Yeah, I'm enrolled in Vanguard's deferred compensation plan, but I just feel like I haven't been able to, I just haven't had a good experience like getting financial like consultation services from them and like them actually taking the time to explain like retirement savings planning and all that. So I really appreciate you doing that here and I will reach out. Thank you.
Yeah, definitely could do a one-on-one whenever you're available. Sure.
Thank you, Doug. Letitia, you want to unmute yourself and ask your question? And then we'll go back to the questions in the chat. Letitia? Bozeman, are you still there? Okay, well, while we're waiting on her, um, can you roll over money from your Detroit Defy, and that to, can you roll over money from your Detroit Defined Contribution Plan, your annuity, to this account?
Great question. Short answer is, can you? Yes. Um, it just really depends where you are in your career and your needs of the money and your age. So yes, you can roll it over because they're both pre-tax vehicles. Sometimes there is a part of the annuity that's post-tax or after-tax. So that portion you would not want to move in there because you don't want to be double taxed. But yes, generally the answer would be yes to that. Many people choose to roll it into an IRA because there are IRA options where you may have the choice if you want to invest in stocks, et cetera. And it opens up the investment world to you within an IRA. And that's an individual retirement account. It's not tied to the employer. But usually we definitely would address that one-on-one to see what's most beneficial and look at the pros and cons of how it would affect you in any way.
Okay, thank you for that.
Mhm.
Letitia, I see you unmuted. You want to ask your question? Okay. How do I get a copy of the example shown? Okay, okay, that was Leslie. I think we answered that question. Jihad did put his phone number in the chat. So if you want to capture that and reach out to him later.
Yeah, I think Linda here, do you suggest no matter where you are financially that you start somewhere? I think Linda, that's a very good, simple question, and the answer would be yes. I think the hardest part, any of us do something that we aren't used to doing, is just starting. I think the hardest part is starting, even if you're starting at a minimum of $25 a pay, that still gets you in the game where then you can increase and decrease in the future. And if time goes on and you forget about it, well, the reality is you started something and you're going to have money in there. And I know, and just so you're aware, from I know many people ask the same question about pre-tax. What does it mean? So if someone's putting $25 away, you're going to lower your paycheck about $17 to $18. So you're physically putting away 25, but because this comes off your gross pay, you're going to affect on your net pay, the bottom line that gets deposited in your bank account, about $17 to $18. So A, you save on taxes in real time, and B, you're starting to save money. Now, for that person that says, hey, I'm going to wait 3 or 4 years because I don't think $25 a pay is enough. Well, the reality is 4 or 5 years goes down the road. I've had many people do this. And if they ran into, for example, to a hardship, if they didn't save at all, then they have no money to go after in a hardship. But if they save for the 5 or 6 years, even if it was the minimally $25 a pay, I've seen people with $5, $8, $9,000 in there where now they're happy they have it if they ran into a hardship. And if they didn't run into a hardship, that's just more money that they have saved going forward. So never think that the minimum is something that should deter you from saving. Save what you can, and little by little, I've trained my clients where every year they put on their phone a reminder to go up $5, go up $10. So then they're more intentional about putting money away, but it doesn't affect them as much out of their paycheck and their take-home monies.
Okay, I think that was the last. Oh, does Equitable have tax planning services?
So we're not an accountant. We do have some strategies regarding tax side. I do work with a lot of accountants in general. So that's something, depending on how in depth that tax question is, I will definitely reach out to the experts because I believe that if I'm a financial advisor, I am here to help you with your investments, and an accountant is helping you with your physical tax side of things. But I do work with a lot of accountants to get a lot of questions answered that many of my clients do have.
Okay, and one last question: how to add additional up to 47,000.
Okay. So the way that somebody is able to add the 47,000 and take advantage of that is basically when they're in their last 3 years of eligibility for retirement. So, for example, if you are somebody that can retire after 25 years, right? Let's just say your official retirement is 25 years. You're allowed to do 25 years and leave the city with your retirement. Then technically your 23, 24, and 25th year, you are able to put in that maximum of $47,000. And that's 2025 numbers. As the IRS increases the annual amount, that will go up. But basically that catch-up provision, it's called a catch-up provision, and you're allowed to do double what the normal standard deduction is, which in this year would be 47,000 within your last 3 years. Does that answer that question? I hope.
Hello.
Hello.
Yeah, that was my question. So
Yeah.
I'm already doing catch up.
Yes.
So the $23,500, I'm past the age limit for retirement. I only have maybe 11 years with the city. So is it based on years of service or my age that I can retire?
Yeah. So I will revert this back to Craig, but I will tell you what I tell my clients.
Okay.
So if you're eligible, for example, to retire, I look at it as a firefighter on the ground, right? They are somebody that has to leave by age 60, right? So if they only have 12 years in and they can't work past 60, then at age 50, or 58, 59, and 60, they can do that double amount. And so after you do that double amount, and even if you're still working, you have to go back after those 3 years back to the other catch-up provision, which is the over age 50. So like for you could technically, if you're over a certain age, you can do that double now, and then you would just go back to the over age 50 catch-up where you can do that endless. I don't know if that exactly helps with you. I think your specific situation, I can identify, if we talk specifically
Yeah, I
of
think
age.
so because I'm past retirement age. I should have retired probably 2 years ago. My maximum retirement age to collect Social Security. So we need to talk because I don't
Yeah,
know.
we could. Yeah. Yeah. And obviously everybody's different. So you're obviously in a situation where you want to save more. You just didn't know if you can and what are the limits. So we can definitely address that and make sure that we don't exceed what the IRS rules are. But definitely if you need the tax advantage, definitely we can do that. And I see a
Okay,
lot of people.
I have one more question.
Go ahead.
What is it? Darn it. So how do you change advisors? Because I've been in with Equitable quite a while. So how would I change over to you as my advisor?
I'm happy to take an appointment with you. I'm not. So my team, I'm a loyalist. How can I say I'm a loyalist to the clients within the city of Detroit. And that what I mean by that is even if there's another advisor on our team that somebody has, and whether you're comfortable, not happy for whatever particular reason, I will service you, even if their name stays on it. I'm a firm believer that the team is greater, if we help each other. So if there's somebody on the team that you'd rather communicate with me, that's fine. I will definitely help you to the max. I have a vested interest. I'm one of the unit managers in the city of Detroit, which means I hold responsibility for good and bad that happen. So to me, I want to make everybody happy and I want to meet everybody where they're at. So you don't have to, make a phone call to that advisor and say, I don't like you. I can definitely help and guide you. If you want to come to me and chat with me, you're welcome to.
All right, thank you very much.
Anytime. And everything obviously is confidential. That's first and foremost in my business. Confidentiality is extremely important. To me, I don't even, if someone says, hey, is so-and-so your client? I don't even say yes or no, because to me, it doesn't matter. and it's not anybody's business. I think the reality is helping individuals is most important and being confidential about their, not only their information, but their business.
Okay, I think that is all other questions for today.
I appreciate the opportunity again, Craig and Geraldine, for this opportunity. This is a first, so I appreciate it.
Yep. Thank you, Jihad, for your presentation. And thank you everyone for attending today. You will receive a copy of this recording and a link to our YouTube page. Thank you.
Thank you, everybody.
Thank you.
Thank you.
Thank you.
Thank you.